Okay, hi, good evening, everyone. Thank you, Jocelyn, and thank you all of you attend this webinar. I'm Regina Chong, a marketing executive and a dealer in Phillip Futures. I'm going to share some basic useful guidelines to all of you. Are you guys ready to enjoy this 1 hour with me? So if you guys have any question or anything you would like to tell me, feel free to type in the question box below, and I will answer the questions after the webinar in the Q&A section later. Before we start to introduce what is futures today, I will need to do a disclaimer. For today's webinar, is purely for education purposes. It do not contain any buy or sell recommendation. If you would like to start to trade in futures market, please seek advice from quality financial advisor. You could find any of my Phillip Futures colleague or even me after the webinar. Today, I will cover 6 basic information you would like to know to start your journey in futures market. Without any further ado, let's jump into our first topic. First of all, what is futures? Before we start into the theory part, I would like to share a story. The figure in the story is just an example. Before the futures contract happened in the market, there's a corn seller sell his harvest corn at 10 ringgit per bushel. But the price will be different from time to time in the market because his corn sometimes is prettier, sometimes he harvests more corn, and sometimes he only has limited corn. So today he can sell at 10 ringgit per bushel, but after the month, he has potential to sell at higher price or the lower price. It very depends on his corn production and how many customer would like to will buy from him, and also the market, the customer mood that he want to buy more or buy less today. So in short, it depends on the demand, supply, and the market sentiment. So it is quite uncontrollable. In the market, beside the buyer, there's another player we call seller. So the corn buyer is appear. It is the popcorn seller. Assume you are the popcorn seller. Now you are the popcorn seller, so you need the corn as your material, right? So you go into the market and buy corn from the farmer, and you use 10 ringgit per bushel to buy the corn, and you think the price is acceptable because you sell 300 boxes of popcorn every day. So suddenly you have an idea. You want to buy from the farmer with using 10 ringgit per bushel after 3 months because you want to save the cost and use cheaper price to buy so that you can earn more profit when you sell the popcorn. So you're giving the idea to the farmer, and how the farmer say? The farmer said, yes, sure can. But why he accept this offer? Because for farmer, he has regular customer will buy corn from him so that he can sell his corn without keeping so much inventory, and he can earn the relatively stable income every 3 months. So why not? They both agreed they will come back to the market after 3 months. So now 3 months after, the corn farmer and the popcorn seller meet in the market again. But today, corn price rise to 15 ringgit per bushel. In this situation, corn farmer will feel rugi. Why? Because he actually can earn more if he didn't promise you 3 months ago, right? So he lose the opportunity to earn more profit. On the other hand, for the popcorn seller, uh, for the popcorn seller, what do you feel? You feel like, oh my God, luckily I have locked the price 3 months ago. So now I can use the 10 ringgit to buy con instead of today price, 15 ringgit. So you're very happy in the inside. But then the seller said, I don't want to sell you at 10 ringgit already. I want to sell at 15 ringgit. He pulls back his word. So, and this is what we call default risk. To eliminate this default risk, the futures contract appear. The exchange, like the Bursa Malaysia, work as a middleman between the buyer and the seller. We used the example just now. They want to use the current price 10 ringgit to lock in to lock for the 3 months after. So they can enter into the futures contract, but to buy or sell the con, to buy and sell the con futures contract at 10 ringgit per bushels on August. So futures initially is to protect the farmer and the producer who need the commodity without worry the price fluctuation, and the exchange is helped to eliminate the default risk because we trade the futures from the exchange, so there is no one will pull back his word last minute. So theoretically, you can see the sentence below here. The futures contract is a legally contract between the buyer and the seller. They buy the con at a specific price, the 10 ringgit, and at the specific date in the future, which is August. So next, I have prepared a standard contract specification table, and I will further explain later. From the table, we can see here is the FKLCI contract specification. There's 5 key components we could focus on. Firstly, the futures is actually a derivative product. It derives from the underlying instrument, for instance, the commodity like corn, or the financial instrument like stocks or indexes. The underlying instrument for FKLI is FTSE Bursa Malaysia Kuala Lumpur Composite Index. The index includes Malaysia top 30 blue chip stocks such as Genting Berhad, Public Bank, CIMB, Top Glove, and so on. The first key component is the contract size. We can use current FKLI value times 50 ringgit to calculate its contract value or the contract size. So if the underlying instrument price is at 1600, we times 50 ringgit, the contract size for FKLI contract is 80,000 ringgit. In other words, this contract is worth 80,000 ringgit value. Next, each contract has a specific tick size. This tick size is the contract minimum price fluctuate in the market. So for FKLI, the tick size is 0.5 index point value at 25 ringgit. For example, the market price is 1600, and when the price goes in my favor, which means I predict the price going up and it really goes up, then I will earn 25 ringgit. But if price drop to 1599 from the 1600, I will lose 50 ringgit here. Move on to the active month. Traders who trade FKLI will normally trade in the spot month, which is June contract for now. Of course, you may trade other month contract as well, but for beginner trader, it is encouraging to trade in active month as many people trade, so the volume is high, and you will able to buy or sell your position more quickly. Next, sorry. So I will continue. Next, there is a settlement of the contract. Contract is either cash settlement or physical settlement. So for FKLI, it is cash settlement, which means it will expire directly into cash after the expiration. So this FKLI traders can trade until the last trading day, which is like yesterday, the 31st of May is the last trading day of May contract. However, we do not encourage trader to trade in last trading day, as generally most of the trader will start to trade in next contract month, the June contract. Finally, there are trading hours. For FKLI, trading hours is 50 minutes earlier and 50 minutes later than the futures, than the equity market open and close. From 8:45 to 12:45 and have a lunch break. Then the second section will start from 2:30 to 5:15. So this is the specification of FKLI contract. What other contracts are in the market beside FKLI? I already categorized them into 4 categories, which is agricultural indexes, metal, and energy futures. Okay, so in these 4 categories, what kind of futures contract you can trade? Basically, anything from physical commodities like wheat, corn, coffee, or the financial instrument like FKLI, Hang Seng Index, and Dow Jones, and etc. Other than that, we have metal futures such as gold, silver, copper, and etc. And for energy futures, we have crude palm oil, natural gas, and gasoline, and so on. Phillip Futures provide over 100 of products and 11 exchange where you can trade for. If you are interested of which product we are providing, after the webinar, you could contact us for the product list. After knowing the various type of futures contract, why should we trade in the futures? What should we trade in the futures market? There's 4 major reasons of people trading in futures market. The most important is leverage. I guess there are some of the people confused what is leverage. Leverage basically is you are able to use the lesser money to trade a greater contract value. At the meantime, a small movement in the market can also be a big impact at your portfolio. How to say that? Let's look into the example. Okay, suppose a FKLI contract is trading at 1600 point. At this price, one contract of FKLI has 80,000 ringgit of value. But a trader in futures market doesn't actually have to come out with this amount. A trader could trade the 80,000 ringgit worth of FKLI with just a small deposit. And this deposit is called the initial margin requirement. And it is also the minimum of fund that traders need to enter into a futures market. The trader to purchase one FKLI contract, the trader had to put up 4,200 ringgit initial margin to control nearly 80,000 ringgit of contract value. It is around 19% of the contract value. As you can see, futures can allow you to leverage a relatively small amount of capital to control a greater value of contract. So let's look into the example of the leverage. We compare the trader trades with full full contract value, amount, and the leverage futures contract. So what is the difference of their profit percentage? In this case, the trader buy at 1600 and sell at 1630. He gains of 1,500 ringgit. So if he traded in the full contract value instrument, he has 1.88% of profit, while in the futures market, he has 35.71% of profit. It's very attractive, right? So you can use 4,200 ringgit to earn 1,500 ringgit. And but you have to bear in mind that if you are losing, okay, so it's possible to earn a lot of money in the futures market. And we have another example, like if the market is not in your favor, the trader loses 20 points here, so which is 1,000 ringgit. In the full contract value instrument, he is losing the 1.25 percentage, while in the futures market, he is losing 23.81%. So the losers are if the losers are substantial, trader has to add more money to cover the losses. The next attractive point is the futures allows bidirectional trading. If trader predicts now is the uptrend or the bullish trend, he can decide to buy the futures, or we also known as long futures. If trader predicts it is in the downtrend or the bearish trend, he can also decide to sell futures, which also known as short futures. As we can see from the chart here, it is an uptrend chart. So we can use a strategy called buy low and sell high. So we buy at the lower price and sell at the higher price to earn the profit. So if market is in the downtrend, we can you also can steady. We do not need to be afraid, as we can sell at a higher price and buy back at the lower price to close the position. And remember that when you are going to close your position, it has to be the opposite direction. If just now you buy and now you have to sell. The next important thing we have to take note is liquidity. Is the contract having high liquidity, and is many investors trade in this contract? Why should we ask this question to ourselves? As if there is high liquidity, meaning there will be many available buyer or the seller in the market, which means you will have higher chance to buy or sell the contract quicker than quicker and in your preferable price. You imagine if a pair of shoes no one would like to purchase, who can you bargain with? But if there's a lot of people want to buy and a lot of people selling the shoes, you can try to bargain at the price you feel like worth it, right? So high liquidity, the better. In this picture, the highest trading volume is which one? Is the May contract, right? Sorry, because these slides I prepared in advance, so it's not the latest information, but in this picture, the highest volume which means has the high liquidity contract month is the May contract with around the 33,000 of volume. So last but not least, futures trading only charge for the commission fees, and the commission fee is subject to the contract. Every contract is different, has different commission fee. For example, FKLCI commission is 15 ringgit per lot, That means if trader enter and exit the position, the transaction cost will be 30 ringgit. It did not charge other fees like stamp duty or the clearing fees. It only charged the commission fees. So this is the 4 main reasons why people trade in futures market. So after we know these 4 points, how can we use the futures to cooperate with my investment portfolio, with the equity market? This table indicates that my portfolio in the equity market. And yeah, this is for the example only. Assume that this is my portfolio in equity market, and I have Public Bank, I have Maybank, I have Top Glove, and Hatalega. And these four stocks is actually the top 30 blue chip stock. So I buy these 4 stocks on 4th of December. As a normal investor, I will buy and will wait the price rise. If the price is dropped, I will very panic and cry in the bed, right? So let's see, after 2 months, my portfolio is lower due to 3 out of 4 of my stocks is falling. The price is falling. So my initial portfolio is 33,040 ringgit. And after 2 months, my portfolio is at 30,610 ringgit value. I have lost 2,430 ringgit in the equity market. So I already lose 2,000 more. Am I able to minimize the losses in equity market? The answer is yes. In this situation, futures contract will be our good hedging tool, as we can enter into the opposite direction in equity market. In this circumstance, the day I enter into the equity market, I have to simultaneously short in FKLCI futures contract to protect my portfolio if the market is going down. So I short at 1625 on 4th of December, which is the market price at that time. After 2 months, the price dropped. So due to the price drop, I have earned 1,950 ringgit in futures market, which offset my losses in the equity market. And this is what we call hedging. Must be noted that there are no perfect hedge exist in the real market, which means it's not possible to offset all the losses I made in equity market. But it is more than enough as I minimize my risk from 2K plus to around 500 ringgit. Another example of hedging is the farmer or the producer will enter into futures contract to manage the risk and uncertainty of the raw material price fluctuation. If the producer do not enter into futures market, he has to worry the corn price fluctuate and the quantity of corn, because he need the material to produce their product. Like the story I shared at the beginning, if the corn price, now assume that if the corn price is going up, it is good news for farmer, which would receive the greater profit, and bad news for the popcorn seller who need to use higher costs to buy raw material, the corn. But they will very head edge of the price fluctuation every day. So to solve this issue, both of them could enter into the futures contract and lock in the price. As time goes, If the corn price goes up, the farmer loses his opportunity to earn more profit because he locks in lower price. However, he do not need to worry about the corn selling price. He could focus on his corn plantation. In producer side, they are protected themselves from the price rising. They are able to control their material costs. If the corn of price going down, the table turn. Popcorn producer could save the material costs while the corn farmers receive lesser profit. It is good news for the popcorn seller, but bad news for the corn farmer now. With corn futures, both corn farmer and producer are able to lock in the price ahead of time. Farmer can sell his corn in the futures market to protect themselves from downside risk. Producer lose the opportunity of lower material costs. However, he doesn't have to worry about their material costs and lack of inventory every day because he already locked in the futures market, in the futures contract, so he could focus on producing popcorn. Besides hedger, there's another player in the market, which is speculator. Speculators are normally purchase the futures contract for a short period of time with intention of profit from the price change. In short, they are gain profit from the price movement in the futures contract. So as a speculator, if I analyze and predict the price movement correctly, I could earn from it. But if I predict wrong, there is no other way to help me to minimize my losses. So in this example, I predict FKLI will going higher. So I buy at 1670 and wait the price rising and sell at 1680. I have gained 10 index point, which is 500 ringgit in this contract. I have earned 500 ringgit. So if the market against me is not in my favor, I will potentially lose 500 ringgit or above as well. Okay, next I would like to introduce our star product, which are FKLI and FCPO. Both products are the most heavily traded product in the Bursa market, in the Bursa Malaysia market, futures market. As I mentioned earlier, the FKLI contract specification is shown in this table. So I will not talk again here. Let's take a look at which attractive point makes trader want to trade in the FKLI. Firstly, the underlying instrument of FKLI is FTSE Bursa Malaysia Composite Index, or known as FKLCI. It is an equity index future weighted of the top 30 blue chip stocks. With the 30 stock price in FPMKLCI move, the index will move as well, and the corresponding of FKLI will move. So if you trade in the FKLI, it's the most efficient method to invest or trading in the top 30 blue chip stock in Malaysia. You could involve trading one futures contract instead of you trade a total 30 separate transaction in the stock market, which will involve a lot of money as well. Second, the traders can leverage by using the 4,200. Can leverage by using 4,200, a small fraction of total contract value as capital upfront. So the contract value of FKLI is 80,000 ringgit, but traders could use 4,200 ringgit margin to gain exposure in the KLCI. And trader could use FKLI as a hedging tool if they invest in the top 30 blue chip stock in the equity market, such as Maybank, Petronas, Genting, and the example just now I showed, which I already covered just now. So furthermore, I'm moving next. There's a various reasons that can affect FKLI price. The fundamental analysis we can look into is the GDP, gross domestic product growth. It is the measurement of the economy of the health of the economy. Here, I will asking some question. You can select from the pools that you feel which one is correct later. So if the GDP announced is better than expected, meaning the economy is expected to be going well. So if the economy is expected to do well, the market is expected to go higher. If the market is expected to go higher, what should you do now? Will you buy or will you sell the FKLI contract? So the post is open, so you can choose the answer. You pick the answer, which one is correct. If the GDP is going up, is going well, so will you buy the FKLI or will you sell the FKLI contract? Yes, I see someone is voting, and yes, you are correct. You can buy the FKLI regarding to the news, because most probably the GDP is higher. Most probably the GDP higher and the economy of the country will going well, meaning the people's quality of life is improving as their income are most probably increased. So the stock will mostly going up and the FKLI will being affected by the stock and going up as well. And next is interest rate. From last year, due to COVID-19 pandemic, our interest rate already reduced from 3% to 1.75%. Usually when you are looking at the interest rate lowering, the relationship between the low interest rate and the stock market is an inverse relationship. What does it mean? Meaning when interest rate low, usually will push up the stock market price because people do not want to put their money into the low interest rate kind of instrument like FD, the fixed deposit, because the return is too low. So they will put their money into the stock market. So this is the inverse relationship. Next question I would like to ask is, if interest rate is high, theoretically, the people will choose to allocate their money into the FD or the stock market. Okay, I give you guys 10 seconds to answer. So if the fixed deposit rate is high, will people allocate their money into fixed deposit or the stock market? Okay, I saw most of the people choose fixed deposit. It is correct. Theoretically, people will put their money into FD because it is less riskier than stock market and stable return as the interest rate is high. So when the interest rate high, you put in the fixed deposit or you put in the your saving account, the rate is nice and you has less risky in this instrument. Then we look at the crude oil price or the commodity price. For Malaysia, this one is particularly important for us. Why? Because we are more like a commodity country. We have crude oil, we have rubber, and all these commodities, this will affect our general economy. Next, I will move on to another star product, FCPO. I will explain the contract specification first. As I said before, it has the underlying instrument, and this contract, the underlying instrument is the crude palm oil. The contract size is underlying instrument point times 25 ringgit. So assume that the underlying instrument of FCPO is 4,000. So times 25 ringgit, and this contract size is 100,000 ringgit. The tick size is 1 ringgit per metric ton. So when market goes up or go down 1 point, we earn or lose 25 ringgit. Here is the example for you to understand more quickly. If now market price is 4,000, I was holding buy position which I predict the price will go up. But it does, I will earn 25 ringgit. I will have 25 unrealized profit and vice versa. So if the price is not, if the market price is go against me, I will lose the 25 ringgit. Besides that, FCPO, SPO is physically delivery settlement at expiration. For example, if any of you long a contract in crude palm oil at expiration, will receive 25 metric tons of crude palm oil and need to pay 100,000 ringgit. However, don't be worried about 25 metric tons of crude palm oil showing up at your front door, because Phillip Futures does not allow client to take physical delivery. You are required to close your position before the delivery date. The other special point, difference from FKLI, is that the last trading day of FCPO is 15th of the delivery month. And generally, traders are actively trade 3rd of the month, the August contract. The trading hour for FCPO is from 10:30 to 12:30, and the second section is from 2:30 to 6 p.m. So after we understand the contract specification of FCPO, why it is a star product in Bursa Malaysia. Firstly, because it is a widely used oil in our life. After this webinar, you may go to your kitchen, you take your bread or instant noodle or the chips or even ice cream. And ladies, you can see your lipstick, you can see the ingredient of your lipstick you are using. Majority of them are contain crude palm oil. It's very widely used in our life. Second, it offers the leverage. By using 6,000 ringgit initial margin to trade in futures market instead of using the full contract value, the 105,000 ringgit. The last attractive point is the market liquidity and volatility. There's an averaging of 25,000 trading volume per day. Is considering a high liquidity product in Bursa Malaysia, and traders are able to earn profit from the price volatility because the average of crude palm oil movement is 100 points per day. Let's say if you earn 20 points and so you have potential 500 ringgit, you can earn 500 ringgit per day. So besides Speculator, it could be a good hedging tool for farmer and producer as well. Like the example I have I have mentioned just now. Now we look into the fundamental analysis of the FCPO. It is more on the demand and supply theory. As we know, Malaysia, our country is one of the crude palm oil producer, right? So let's make a guess here. Who are the top 3 crude palm oil producer? Who are the top 3 crude palm oil producer? You can choose 3 of it. So firstly, we already know Malaysia is one of it. Yeah, you can choose which 3 is the top 3 producer country of crude palm oil. Yeah, most of the people is correct. The answer is Indonesia, Malaysia, and Thailand are the countries who support most crude palm oil in the world. So, if any of these 3 countries facing the issue of weather like El Nino or the La Nina will affect the production of crude palm oil. El Nino is a dry, warm weather, while the La Nina is usually cold and wet and tend to cause heavy rain, or the worst will causing the flooding. Weather and the labor for harvest crude palm oil will affect the FCPO price as well. Next, we make another guess on the top 3 consumer countries. I will giving some tips for you all. These 3 countries have a lot of people living. There's high population in these 3 countries, so they assume a lot of crude palm oil. Yeah, so you can make a guess here. Which countries are the top 3 consumer of crude palm oil? Okay, I'm giving 5 more seconds. Okay, so from the latest news, we can see the top 3 consumer crude palm oil countries are Indonesia, India, and China. And Indonesia is a self-sufficiency country. They produce crude palm oil and they self-consume. If have extra crude palm oil, they will export to other country. So next, the second fundamental factors will be MPOB data and MSPEC SGS data. MPOB stands for Malaysia Palm Oil Board. It is an associate and also a board for Malaysia Palm Oil. This is one of the very important data being shown every month of the 10th. The performance data you can find at MPOB website are export data, production data, and inventory data. These 3 data is very important for the FCPO if you want to trade FCPO. The other data we can refer are MSPEC and SGS data. Both export data is recorded from the cargo surveyor. It will be released on 10, 15, 20, 25, and the end of the month. It can be 30 or 31 or the 29 or the 28. It depends just the end of the month. And the third basic principle that we can look at is the substitution product. There are several edible oil that can replace the crude palm oil, such as soybean oil or sunflower oil. They have similar function, and most relevant is the soybean oil. When the price of soybean oil rise, the price of crude palm oil will most likely to getting higher. Why? Because people will think that the price of soybean oil is too high. It is not worth it. So people will buy the cheaper oil and similar function, which is the crude palm oil. So FCPO price will likely to going up. This is the correlation between the oil substitutions. Okay, until this point, we know that the fundamental analysis that affects FCPO price is the data, weather, supply and demand, news, and so on. So after we knowing the fundamental analysis, we can we look into the other analysis called technical analysis. Most of the trader using technical analysis to find the trading opportunity in the futures market. I will cover some basic technical analysis here. Okay, right here we can see a red and green candlestick. We can read the price and market sentiment by reading this candlestick. The real body is the piece that was just covered in here, and it is basically takes the difference between where it opened and where it closed. So the green candle represents rising price. It is open lower and close higher, whereas the red candles show the price falling. The open price is higher and the closing price is lower. Most investors using candlestick chart for their preference tool of analysis because candlestick provide all of the requirement information at a glance. Not only that, each candlestick, this one candlestick, so if each candlestick added together will form a candlestick chart. Like this is the candlestick chart. And before we start trading, we must understand the trend in the candlestick chart. Put simply, the market trend is essentially of the general direction a market is heading. So a market can trend in three directions: the uptrend, down, and the sideways. A market that is said to be an uptrend typically will making the higher highs and the higher lows. Like in this picture, it making the higher highs continuously high and the higher lows. So it fulfill the requirement. So this is called the uptrend lines. Next, as the market is going downtrend, it will making a lower highs and the lower lows. Overall, we can see the price is going down, and the price is not making any higher since here. It's not making any higher, it's going lower. And third market trend is sideways. It will typically not be making any significant movement higher or lower. It is commonly known as the horizontal trend. The trend of the market is very important to some trader because they are trade in the direction of the trend. So next we come to the support and resistance line. This form of analysis is a fundamental of mostly all trader approach. So the bottom line here is the support line, and the lowest here is the support line, and it forms when the price keep bounce back from the support and do not fall below this line. You can see from the chart, it do not fall below this support line, so it's very strong support line here. And the resistance line is formed when the price rising, but it cannot break new highs. So the price will drop after touching this line, we call resistance line. And a key characteristic of support and resistance level is once a level is broken, it becomes the opposite to what it was before. What I mean by this is if a strong level of support is broken and the price moves past it, the support line will act as a resistance line. If the price could not break high, cannot break through higher, and vice versa. Last but not least, we have chosen which futures contract we want to invest in, and we know when we want to enter into the futures, into the position. Now we just got to place the order. There are three common order types, which is market order, limit order, and stop orders. Let's start with the market order. This order type will be executed at any current market price. It indicates that you want your order filled immediately at the next available price. So if the price keep changing, your order may be filled in different price that you initially wanted. So for the market order, you can refer to the ask price. You can refer to the bid ask. If you want to buy at market, you can refer to the ask price. The ask price meaning the seller is willing to sell at this price. So the buyer, as you, would need to see the ask price. Refer to the bid price if you want to sell at market. So the bid is meaning that the buyer willing to use this price to buy. For example, now I want to buy a futures contract at market price. So when I place the market order, my order will most probably be filled at 3501. Next, investors who use market order tend to be more concerned about the speed of the trade than the price. So without the price restriction, the order type has the best chance of being filled. And investors typically use market order during trading hours and in highly liquid market. So because their priority is to buy if your priority is to buy or sell at the exact price or better price, you may want to use the limit order instead. So with a limit order, you can specify a price, and the order won't be filled until the futures contract can be bought or sold at the designated price or better. So the investor generally will use limit price when they have a target entry or exit price, and they are willing to wait the market to move to the price they want. Let's say, for example, the FCPO is currently trading at 3500, but an investor believes it will be a good value at 3480 or less. So this investor could place a limit order to buy the FCPO at 3480. If the market price never reached the price we set, the order would never be filled. If the price dropped to 3480 or below, with enough volume available in the market, the order will fill and the investor will buy the FCPO for 3480 or less. On the other hand, if the investor thinks that the price will fall after 3510, then the investor can place a limit order at 3510. Order will be filled when the price reaches at 3510 or higher. In simple terms, we place a limit order at specific price to enter or exit the market. So our order will be queuing until the market price reaches the price we set. However, because the price restriction, there's no guarantee that your order will be filled quickly or will be filled at all. And the last order type is stop order, which is stop order are most likely to use for minimize the potential loss in an investment. For example, an investor holding a buy position, which done at 3500, he thinks that the FCPO price is likely to rise. However, he also afraid that the market will go against him. So he placed a sell order at a sell stop order at 3450, which means that he can tolerate the 50 points of potential loss. This might prevent more severe loss by getting out before price fall too far. So other than that, there's a risk that order will not be filled if the price get up or get down. So the stop order will be only filled when the market price is reached that the price you set, or if not, your order will not be filled. So today we have been learning what is futures contract, and they are standardized contract and have their unique unit to calculate the contract value, different trading hours, and so on. And there's 4 common types of futures contract: the agricultural futures, index futures, metal futures, and energy futures. The most attracted reason why traders will trade futures are the leverage, bidirectional, high liquidity, and low transaction costs. Besides that, we also learn how the fundamental analysis will affect FCPO and FKLI price, and the basic of the technical analysis and the order type which are commonly used in futures trading. So after hearing this webinar, what can you do? You may start your trading journey from now by using our demo account. It is a live chart and various of tools you can use for charting. We have desktop and mobile apps version. You can scan this QR code and register for the demo account. Next thing we can do is call paper trade, which you can write it down every day, which product you would like to trade, which point you want to enter, you want to take profit, and you want to stop loss. And if you can provide a reason beside for your reference in future. Based on maybe based on the support and resistance, I predict the price will rebound, so I take profit at here, and I place stop loss at here. So if you overall you are well prepared, you can scan this QR code to open an account online with us. It is free of charge, and we do have a desktop and mobile app version. We offer various types of product, and you can start your trading journey with us. Do not forget to tap PJB when you register an account online. So now we are going to our last section, which is Q&A section. Let's see, is there any question? So I have a question here, and is there any maximum limitation period to hold the contract, and how the commission count? So for this question, the maximum limitation period is the last trading day of your contract. If let's say the FKLI, we usually trade in the spot month. So in June contract, like in June now, we can trade the FKLI until the last trading day, which is the 30th of the June. But which we do not encourage people hold the position until the last day lah. So you can trade from 1st of June and trade until the 31st of June. And each contract is is very different. So if you're interested in any contract, you can contact me later. And the commission is different as well. For example, the FKLI is 15 ringgit per lot, like I said just now. And another question, and the last question from here is, people ask, so you can only short the FKLI index. This is not correct. We can long the FKLI and we can short the FKLI. It is bidirectional trading in futures market. Okay, so we have some question, but due to our time is limited, So I will answer your question after the webinar. I will WhatsApp you to at tomorrow. So lastly, if you have any question you want to know, maybe the product we provide or anything you would like to ask, you can contact us by this hotline or email us by this pfjb@poems.com.my. So thank you all for attending this webinar. Hope you learned some of it. So thank you all and bye bye.